Let's just tackle this US bond yields, German bond yields rallying, and whether it will have any impact on emerging market and Asia just yet or today and in this week. Rohit Arora, the Asia Interest Rates Strategist at Barclays, joins us on the phone line from Singapore. Rohit, we saw this 9 basis point rise in US bond yields, 2.38 at one point in time, and German bonds as well. Should we worry about further impact on emerging markets, both bonds and equities?
Yeah, hi, good morning. I think if we look at the recent sell-off in US Treasuries or developed market yields, there are three reasons behind it. One is, of course, the valuations were getting into richer territory, and as a result, any turnaround in data had to increase volatility. So that has been happening since mid of April, and has been more or less behind the sell-off. In fact, if we look at the sell-off, it has been mostly driven by real yields. Second is because the volatility is higher, that combined with banking regulations is making the stop losses exacerbated. And the third is the recent central bank speaks, be it Fed or be it ECB, has been more or less less dovish than what the markets were expecting. So more or less bond yields are behind the recent sell-off, and given the sharp rise and increased volatility, we have to be watching it more closely, and it can impact any fixed income market in the world. Second, what does it mean for emerging markets fixed income? Given that it is more or less resulting in a volatility shock, surely the lesser liquid EM fixed income markets will also be impacted. Today, as well as yesterday, we have seen such similar to larger sell-offs in most of the regional markets, be it Singapore, be it Thailand, or be it Indonesia. India, of course, is also seeing sell-off, but again, it is mostly driven by its own monetary policy concerns rather than US at this stage.
Okay, Rohit, hi, morning. What does all of this mean for emerging market equities like India?
Equities, like what we saw overnight was there has been kind of a divergence in the different assets, if we see. The volatility in fixed income markets has certainly increased, but if you look at what is happening in the overall FX or equities world, wars are still kind of depressed. So at this stage, it's a bit early to say what it would mean, but yeah, if it continues for another 3 weeks and we see moves like taper tantrum, sure, we could see some kind of impact on equities as well.
Okay, but would you attribute even the recent sell-off that we have seen in most emerging markets over the last week or so to the rise in these yields?
Not necessarily. Some of the sell-off we have seen in developed markets has been more or less to kind of mixed data. Okay. Second is what we have seen in a few emerging markets is more or less driven by the decline in commodity prices, and because a lot of emerging markets are linked to commodities, the weakness over there has been reflection of the same. And elsewhere in a few regional markets in Asia, I would say it's more driven by idiosyncratic moves. For example, in India, it was more or less driven by RBI policy and its implications on banking stocks.
All right, we'll leave it at that. Rohit, thank you very much for joining us.